The Federal Reserve on Wednesday raised interest rates for the first time since 2018 and laid out an aggressive plan to push borrowing costs to restrictive levels next year in order to counter the economic risks posed by excessive inflation and the war in Ukraine. The U.S. Central Bank's Federal Open Market Committee kicked off the move to tighten monetary policy with a 0.25 percentage point increase in the target federal funds rate. Here's Fed Chair Jerome Powell announcing that move.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting.
More notably, though, the new Fed projections showed that policymakers were ready to shift their inflation fight into high gear by possibly raising federal fund rates at each of its remaining 6 meetings in the year if there's no marked improvement in inflation.
We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment, and we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Now, while the Fed tries to fight this inflation, Seema Shah, the chief strategist with Principal Global Investors, warned that, quote, rarely has the Fed safely landed the U.S. economy from such inflation heights without triggering an economic crash. Just for reference, the Fed's preferred measure of inflation is currently increasing at a 6% annual rate.
Go to FISM.tv/news for more.